Hello everyone. We are Money in Minutes and we'll be presenting the book Beating the Street by Peter Lynch and follow it will be followed by some economic themes and indicators. The members of the group are Shreyans Jain, Shubham Kadhi, Siddesh Parekh, Ayush Jain and Ayush Kora. We'll start off by evaluating SNLs. So Peter Lynch started by explaining how we evaluate SNLs or savings and loans account. The idea is not to get lost in the technical jargon, but to focus on the few signals that clearly separate strong institutions from the weak ones. The first thing that Peter Lynch looked at was the equity to assets ratio. For SNLs, a healthy level is anything above 7.5. This number tells us how much buffer the institution has if things go wrong. The institutions that survived major financial crises often had strong equity positions, which gave them the resilience to absorb the losses. It also makes them attractive takeover targets because stronger balance sheets reduce acquisition risk. The next thing that Peter Lynch examined was the risk profile of the loan book. Strong SNLs limit their high risk loans, like commercial or construction loans, to up to 5 to 10% of the portfolio. Why did they do this? Because historically, these were the loans that caused the most failures. A good SNL sticks to what it knows best: traditional residential mortgages. The last thing that he looked at was on the investment side, that is the low PE ratios, stocks that were trading below the book value and gave out solid dividends. These were typically undervalued but fundamentally strong SNLs. So, attractiveness of any thrift institution. Uh, so, by putting these indicators together, we can quickly judge the health, stability, and attractiveness of any thrift institution. Siddesh will continue.
Hi guys, Siddesh here. Let's look at the example of SLN. In the middle of one of the banking failure, a few SLN didn't just survive; they thrive. How? Let's break it down. Well, our first example was a Golden West. The thrift just come from the 96% of loan is in a plain resident mortgage. This is the safest and the most predictable segment. And the most importantly, they stayed away from the junk bonds and the high risky loans. The Golden West is a proof that the steady a boring banking can aggressive strategic every time. Glance bankrupt and people saving is the next example. This bank built financially foundation. They equity to asset were 9 to 13%, give them a three capital buffer. Why were they so strong? Because they focus on loyal local depositor and keep default extremely low, even in challenging region. Now Shreyans will explain you further.
Hi everyone, Shreyan this side. I'll be explaining you shopping for stocks. We often think that great stock ideas come from complicated models, long financial reports, or expert recommendations. But the truth is, sometimes the best ideas are already around us in our daily life. Think about the brands you see in the malls, the queues outside a cafe, or how certain products suddenly become popular. These small observations can actually tell us something about business trends even before they show up in news or financial statements. For example, if every time you go to a mall, you notice a particular store is always crowded or a new product is always sold out, that might be a sign that the company behind it is doing right. On the other hand, if a store looks empty or neglected, maybe it tells us the business is losing relevance, right? So in a way, the world outside a desk becomes our biggest research lab. Peter Lynch has quoted a principle. If you like the store, chances are high that you will love the stock. He has simple philosophy. Start by noticing what you already like or trust as a customer. Now, my colleague Ayush Jain will explain you the examples.
Hi guys, Ayush Jain this side. Now let's look at how Peter Lynch used real world signals to spot scalable businesses long before the financials made them obvious. This is not just a casual observation, it's about reading early demand patterns, customer behavior, and business model efficiency before the market notices. Start with supercuts. Lynch did not just see busy salons, he saw a repeat purchase services with low operating costs, fast turnaround, and a store format that could be cloned easily. Strong footfall across locations act as a real world indicator of stable same store sales and predictable cash flows. Next, the body shop. Long before sustainable beauty become a trend, the brand has strong tractions with younger consumers. When a brand shows organic buzz and consistent visibility, it often signals pricing power and a long growth runaway. Lastly, clearly Canadian. Here, the signal came from consistent household purchases before national sales data showed any spike. When consumption picks up at home, then appears more often in retail stores. Across all three cases, the insight is simple. The market is always late, but real world data is early. Now Siddesh will continue.
So here one the interesting concept on lousy industry. Some of the best multibagger comes from the worst industry. Let me explain. When an industry goes in a downturn because of pricing pressure, high cost, or oversupply or a weak demand, it looked terrible from the outside. Peter Lynch call it a lousy industry, but inside the chaos, it lies a massive opportunity. In a downturn, most of the weak companies start falling. These are one with the high debt, low margins, weak balance sheet. Now here is where the magic happens. A few companies that do survive, they usually that ones with the strong cash flows, low debts, low cost producer, they suddenly find themselves a less competitive. Then the capacity shrinks, pricing stabilize, demand eventually return, right? And the survivor capture all the market shares and the weak player left behind, because the industry has a fewer player, the survivor get a higher market share, better pricing power, and improve profitability. Now Ayush Kora will explain the examples.
So now I would like to highlight Southwest Airlines, a company that didn't just survive but outperformed in one of the worst industries in the world, aviation. Peter Lynch calls this airlines a lousy industry due to the high capital cost, fuel volatility, union pressures, and also constant price wars. Yet Southwest became an outlier. It succeeded not because the industry changed, but because Southwest refused to play by the industry rules. Firstly, it flew only one type of aircraft, the Boeing 737. This single choice allowed them to lower maintenance and training costs and schedule efficiency. Then they also focused on short hauls, quick turnarounds, and no frills that kept their cost structure below every rival. So Lynch's key takeaways was you can win in a lousy industry if you are uniquely disciplined and you are structurally cheaper than everyone else. So Southwest didn't just change aviation; it changed how a business could operate inside aviation. Now I would like Ayush Jain to continue.
So now let's move into one of the Peter Lynch's most powerful ideas, something he applied constantly, but even though he never gave it an official name, paying the right price for growth. Today we call it the PEG ratio, and it's one of the simplest way to avoid overpaying for great businesses. The rule is straightforward. Your PE should not be higher than the company's growth rate, whether that growth is measured by PAT or EPS. Because the moment PE runs ahead of growth, your payback period stretches from a healthy 5 to 7 years to 10 to 12 years, and your expected returns fall below even the 10% average return of Nifty or Sensex. If you are targeting 18 to 20% CAGR, the price must line up with the growth. Now look at the slide. Company A, PE 5, growth 10%, ratio 0.5. You are paying half the growth rate. Company B, PE 15, growth 20%, ratio 0.8, still attractive. Company C, PE equals growth, fair deal. But the problem starts with D and E. D trades at PE 60 for 40%, PE jumps to 1.5. E trades at PE 125 for 50% growth. The ratio stands at 2.5. At those levels, your payback period becomes so long that even a basic index fund will beat your so-called high growth investments. So the key takeaway, exactly in line with Lynch's philosophy, is this: growth only creates wealth when the price you pay does not dilute the returns. Now Shreyans will continue.
So now that we understand the PEG ratio, why paying the right price for growth matters, let's connect it back to the book with a few real examples Peter Lynch actually used. The first example is Sun TV in 1991. At that time, the stock was selling for around $18 and its PE ratio was 50. But what made it interesting wasn't just the price, it was the growth rate. Sun TV was growing between 25 to 30% per year, which means the growth was almost double the valuation multiple. In fact terms, that made it an attractive buy because the market wasn't fully valuing the growth potential yet. Another example which give is from financial sector, that is saving and loan. Some of these companies were growing earnings at nearly 15% annually, but their PE ratio was just 7 or 8 based on recent earnings. Again, that's the situation where the growth rate is higher than the valuation possible, which signs undervaluation and an opportunity for investor like us who recognize it early. Then the sovereign bank of analysts expected the company to grow at least 12% a year, yet the stock traded at a P of just 8. The only negative was dilution from issuing extra shares. But even with that, the valuation didn't reflect the growth trajectory. In Lynch framework, the imbalance between price and growth made it worth investigating, not ignoring. Now, Ayush Kora will continue.
Cyclical. So, what are cyclicals? Cyclicals are businesses whose performances rise and fall with the overall economy. When the economy expands, their earnings and share prices surge, but in recessions, both decline sharply. Unlike stable compounders, cyclicals demand timings, not long term holdings. We usually find cyclicals in industries like autos, steel, aviation, chemical, paper, and aluminium. Basically, sectors whose demand mirrors consumer spending and industrial activity. The core investing rule is simple: buy at the bottom and sell at the recovery. The best entry point is when earnings are depressed, sentiment is negative, and demand is just beginning to turn. Peter Lynch also warns not to treat cyclicals as growth stocks. A high PE at the cycle bottom is not a red flag but a signal that the earnings are temporarily suppressed. And conversely, a low PE at the top is dangerous. It often means that the boom is peaking and the earnings are about to collapse. Successful investing in cyclicals requires awareness of industry signals like capacity shutdowns, weak players exiting, and pricing trends. Now, I would like my teammates to continue.
Coming to the examples of cyclicals, uh, some of the examples where Peter Lynch's approach really standard out was Phelps Dodge. Phelps Dodge was a company that Lynch noticed something interesting in the early 90s when copper demand was quietly starting to rise. Commodity cycles usually turn out slowly, but markets tend to react late. So while everyone else was still focused on the negative headlines, he saw the early signs in recovery. This is the core lesson in cyclicals. The first signal is rarely the earnings; it's the fundamentals. In this case, rising copper demand combined with supply tightening showed that the down cycle was bottoming out. The next company he looked at was General Motors. Lynch did not rely only on company numbers. He tracked used car prices as an indicator because when used car prices fell, it signaled weak new car demand. But when they started rising again, it meant that consumers were coming back to the market. Auto cycles usually take years to recover because inventory, financing, and consumer confidence all move very slowly. Lynch caught this early turn and bought General Motors before earnings had fully recovered. But he also warns that even when a cyclical company recovers, it does not always outperform true competitors. General Motors rebounded, but it wasn't a long-term hold. The trick was to ride the recovery and exit once the cycle matured. Now, let's move on to some of the economic themes. First, we'll talk about the effects of repo and CRR cuts and why they matter for the economy. To begin with, what is a repo rate? Repo rate is basically the interest rate at which banks borrow short-term money from the RBI. So when the repo is lowered, banks can borrow more cheaply, and that directly flows into the economy in the form of lower loan rates. Home loans get cheaper, business loans become more affordable, and even personal loans come down. This encourages both consumers and companies to borrow more, which increases spending and investment. Next comes the CRR, or the cash reserve ratio. This is the percentage of deposits that banks have to keep with the RBI and cannot use for lending. When the CRR is cut, banks instantly have more funds available with them. Think of it like a liquidity injection. Suddenly, there's more money circulating in the entire system. In the short term, The CRR cuts and the repo rate cuts are great news for the economy. Consumers benefit from cheaper loans, business find it easier to expand, and overall spending in the economy rises. That's why we usually see a pickup in demand for houses, vehicles, and capital goods after such rate cuts. But in the medium term, the RBI has to be cautious. If credit grows too fast or too cheaply, it can push inflation up. And when inflation rises, the central bank might have to reverse the cuts and tighten the rates again. Right now, in India, the repo rate stands at 5.25%, TRR stands at 3%, and GDP growth at 8.2%. Siddesh will follow.
So hello guys. Now let's look at the India's growth driver. For last 45 years, India has delivered a average 6% real GDP growth. And here the crazy part, the India has survived a major global crisis like oil crisis or dot com crash, global financial crisis, COVID, and everything. A few countries in the world have shown such a steady long-term resilience. This consistency is a foundation of India's growth story. Is the India's biggest economy driver. As a household demand shifted from a rural to urban area, you will see a massive secular in a rising demand. Every family that move into city spends more, upgrade more, and consume more. And this is a trend continue for a decade. A 10 wheel was a young workforce. India is only a major economy that have a rise in working age population for the next 30 years. And this demographic trend will more productivity, more consumption, and a stronger economy. Most countries, including China, are now aging. India is getting stronger. Now, when a combined stable growth, rising urbanization, world-class talent, and a young workforce, and a falling inflation, and get on the strongest multi-decadal economy in the story. India is not just growing; it's compounding. Now, Shreyans will explain the next thing.
I'll be explaining you China plus one. China plus one idea meaning companies and global supply chains are increasingly looking beyond China and considering alternatives like India, Vietnam, Bangladesh. First, why China plus one? Rising geopolitical tensions and supply chain disruptions have made business rethink dependence on a single country. Company wants risk diversification, spreading manufacturing design across multiple countries to avoid being too dependent on one country. Also, rising labor costs and regulations in China make alternative destinations more attractive for cost and flexibility. This creates an opportunity for a country like India. India's recent progress makes China plus one looks especially promising. For example, foreign investment into India has risen, showing growing confidence in India's manufacturing potential. Over the last 6 months, from April to September 2025, smartphone exports from India reportedly jumped by about 59% compared to last year, a surge driven by rising global demand and shifting global trade. However, it isn't all smooth sailing. There are real challenges when comparing to China's scale and ecosystem. For instance, China manufactures at massive scale. Because of that scale, China remains cost competitive. High volume means lower per unit cost. Replicating that volume in India will take time and investment. On the logistics front, China has deeply integrated manufacturing and supply chain infrastructure. India's logistics system and component system is improving, but many parts are still improving. For example, while Indian companies have started assembling PCBA, that is, printed circuit board assemblies, used in many electronic items, they often still rely on materials, raw materials like PCB or other components which are sourced from China. Now, Ayush Jain will explain you PLI.
So let's come to the PLI scheme. India's main push to shift manufacturing from assembly to high value production. The idea is simple. Reward companies for higher output and higher domestic value add. In auto sector, the government is set to cut allocation from 2,800 crores to 2,000 crores because actual verified claims for FY26 are also landing near 2,000 crores. Tata Motors and Mahindra alone accounted for 680 crores, and only 18 of 42 eligible firms have qualified. In aerospace, the momentum is the opposite. The earlier 120 crore drone PLI ended in FY24 after disbursing 98 crores. But the industry now wants a full-scale long-term PLI. The market is expected at 21.48 billion by 2030. Exports are $6.9 billion. Meanwhile, ACC batteries are struggling against a 50 gigawatt hours target for 2024. Only 1.4 gigawatts is ready. Overall, PLI is high impact but high discipline. Some sectors are scaling fast, others are behind the curve. Now Ayush Kora will continue.
So now I would like to talk about the key developments in the artificial intelligence space which are shaping the global and Indian tech landscape. Firstly, Meta has acquired Limitless, a AI wearable startup known for its pendant that records and summarizes real-world conversations. This is Meta's push towards super intelligence and making AI a seamless part of daily communication. Secondly, while the AI sector continues to expand rapidly, Aware Super CIO has flagged orange lights as AI valuations have surged. But the question remains on heavy investment. When will they convert into profits? Still, he believes that long-term AI outlook stays strong if companies execute responsibly. Finally, in India, AI has become the core growth engine. Around 74% of new IT deals are now AI driven, signaling a clear shift traditional services. After a slow period, the industry is set for a sharp recovery in 2026, with growth potentially rising to 7.7% in FY27. Firms like TCS, Wipro, HCL Tech, and LTI Mindtree are already leading this transition. In short, AI is accelerating innovation, stretching valuations, and resetting the future of Indian IT. I would like my teammate to continue.
Every time a stock market crash, gold suddenly become the hero. Why it's so? And why the gold has surged more than 50% recently? Let's break it down clearly. If you look at the any major crisis like in recently was COVID-19, the global financial crisis in 2008, you will see the exact same pattern that equity sharply fall and investor panic and running money rushes to into the gold. And why gold has seen as a safe haven asset where when fear spike, people want to safely and gold become the first choice. But once equity start recovering, and gold usually cool off or consolidate. And gold has surged over 50% recent. Why the gold has surged 50% recently? The biggest driver is the central bank. The central bank across the world has buying the gold aggressively at a faster pace in a decade. Why? Because many countries want to reduce the reliance on a US treasury and deliver their reserves. And for the first time since 1996, the central bank collectively hold more gold than a US bond. This is a massive structural shift. As the demand rises, a supply remain limited, a gold price surge sharply higher. When you study the international reserve data, you will see something remarkable. Countries gradually are reducing their US dollar exposure and increasing allocation to gold. And the reason is simple: gold has no default risks, no insurance. Gold has an insurance against the inflation and a currency volatility. Now, Shubham will explain with the tariff theme.
Yeah. The Trump tariffs. A lot had happened in the first half of 2025. Everything began on the 2nd April 2025 when the US announced the reciprocal tariff regime. This basically meant that if another country charges high tariffs on the US will match it. A baseline tariff of 10% was put on most imports, but for India, the effective rate worked out to be around 25 to 26%. So India immediately became one of the more affected countries. By early July 2025, the US extended the pause on the rollout. This was essentially a negotiating window and it temporarily delayed the harsh measures because discussions were still ongoing. Then the big moment came on 30th July, stretching into the first week of August. That is when the Trump administration formally announced a 25% reciprocal tariff, specially targeting India. This time, the coverage was broad. Textiles, gems and jewelry, leather, and some categories of machinery were hit the hardest. A few days later, between August 6 to 27, things escalated even further. The US added another 25% penalty, but this one was directly tied to India's Russia oil purchases. If fully applied, the total tariffs could reach almost 50% on some categories. During early August to September, there was some relief though. The US clarified that pharma, electronics, and smartphones would be spared. This was significant because India is a major exporter of generics and also a growing electronics manufacturing hub. Then in mid-November, from the 16th to the 18th, we saw first signs of easing. Some agricultural tariffs were rolled back, giving some exemptions to tea, coffee, spices, cashews, and few tropical fruits. Finally, by December 2025, the situation shifted into a more diplomatic. Senior US trade officials visited India, signaling that negotiations were still active and the overall status was continuing to evolve. Now we'll move on to the economic indicators. In the bottom right, you can see PMI manufacturing. Usually when the PMI is above 50, it is considered a good sign for the economy. In the last few years, as you can constantly see, India's manufacturing PMI has always been above 50. Currently, it's between 56 and 57. Moving on to PMI service by Ayush Jain.
The PMI service chart. This shows that India's services PMI has stayed well below 50 from November 2023 to November 2025, meaning continuous expansion. We saw a brief dip to 57 to 58 in mid 2024, but the trend quickly recovered, peaking near 62 in mid 2025. The latest trading around 58-59 still signals strong demand, steady new orders, and a healthy service economy, supporting overall growth. I'll move forward.
The above chart is about need and read. How are they performing? NEED stands for nominal effective exchange rate. This tells us how the rupee is performing against a basket of currency, not just the US dollar. So if NEED is falling, it means the rupee is losing value compared to many currencies that India trades. Then we have REED, which stands for real effective exchange rate. This takes NEED and adjusts it for inflation differences between India and those trading partner countries. REED helps answer a deeper question. After inflation, is the rupee stronger or weaker in real purchasing power? Recently, both need and rate have fallen. Need is down sharply, which means the rupee isn't just weak against the dollar, it's weaker against a wide set of global currencies. At the same time, REIT has also declined. And that's the important part. Because inflation in India has been relatively low. The fall in REIT confirms that the rupee's depreciation is meaningful and not just a temporary fluctuation. Now, Siddesh and
So now let's look at the IAP data. If you look at the chart of index of industrial production or IAP, from the chart you can see the production is fluctuating month or y or with a peak around earlier in 2005. But look at the broader pattern. The index is consistently stay above 150. The growth rate swing due to a seasonal effect and a global demand cycle. But overall, India's industrial sector is expanding, not contracting. Right now, Ayush will explain the credit growth.
So next up is non-food credit, basically loans given to businesses and consumers, excluding the food procurement loans. This is one of the best indicators of economic momentum. From mid 2023 to mid 2025, non-food credit has been rising steadily, crossing well above the 1.75 lakh crores. Why does this matter? Because rising credit demand means that consumers are spending, companies are expanding, and also investment activity is rising. The same trend shows up in the total bank credit. From January 2024 to January 2025, credit has been on a smooth upward trend. What does this tell us? Tells us that banks are willing to lend, borrowers are confident enough to take loans, and the financial system is stable. So these indicators together, what do they tell us about the big picture of the economy? It tells us that the industrial output is rising while the borrowing is also rising and bank lending is healthy. Together, these indicators put an economy that's expanding steadily, supported by strong demand, business confidence, and a stable financial environment. So this was us, Group Money in Minutes, and that was a summary on the book Beating the Street, and also our take on the key economic themes and indicators prevalent in our country and globally. Thank you.